Discover how aligning your investments with your income needs can create a steady stream of passive dividend income every month. In this video, I'll show you how to build a personalized monthly dividend portfolio from scratch, even if you're just getting started. Before we dive in, please remember, this video is for educational purposes only and is not financial advice. Always do your own research and consider speaking with a financial advisor before making investment decisions. Let's get started. Why does building a monthly dividend portfolio matter? Many investors are drawn to dividends because they offer a way to earn cash flow from your investments. Instead of relying solely on stock price growth, dividend-paying stocks and funds can provide steady, predictable income. This is especially helpful if you're looking to supplement your paycheck, cover monthly expenses, or work toward financial independence. By carefully building a portfolio that pays you every month, you can align your investments with your real-life cash flow needs. But how do you actually create a portfolio where money comes in each and every month? Let's break it down step by step. First, let's quickly cover some essential terms you'll hear throughout this video. A dividend is simply a payment companies make to shareholders, often from their profits. Some companies pay dividends every quarter, some pay monthly, and some pay none at all. Dividend yield is the annual dividend divided by the share price, expressed as a percentage. For example, if a stock pays $1 per year and costs $20 per share, the yield is 5%. The payout ratio is the percent of a company's earnings paid out as dividends. A sustainable payout ratio is important because you want companies to maintain, or ideally grow, their dividends over time. Finally, diversification means not putting all your eggs in one basket. By spreading your investments across different companies, sectors, and even types of dividend payers, you can reduce risk and create more stable income. Now, let's walk through the steps to building your own personalized monthly dividend portfolio. Step 1. Define your dividend income goals. Start by asking yourself, how much monthly income do you want your portfolio to generate? This could be $100 per month to cover a utility bill, $500 for groceries, or even more for larger expenses. Be realistic about your timeline. Growing a portfolio to generate meaningful monthly income takes time and consistent investing, but setting a goal gives you a clear target to work toward. Let's say your goal is $200 per month in dividend income, or $2,400 per year. This target will guide your investment choices and allocation. Step 2. Understand the dividend payment calendar. Most U.S. companies pay dividends quarterly, which means 4 times per year. However, some stocks and many real estate investment trusts, or REITs, pay dividends every month. To get monthly income, you don't need to buy only monthly payers. By combining stocks and funds that pay in different months, you can stagger your payments to cover each month of the year. For example, Company A might pay in January, April, July, and October. Company B pays in February, May, August, and November. Company C pays in March, June, September, and December. If you buy shares of all three, you'll receive dividend payments every single month, even though none of them pay monthly on their own. There are also ETFs and funds specifically designed to pay monthly dividends. Well-known examples include the Vanguard Real Estate ETF, ticker VNQ, and the Global X Super Dividend ETF, ticker SDIV. Step 3. Choosing your dividend stocks and funds. When selecting investments for your portfolio, consider the following. First, look for companies with a history of consistent dividend payments. You can find this information on financial websites or through your brokerage. Next, check the dividend yield. Higher yields are tempting, but very high yields can signal risk. For most portfolios, a yield between 2 and 6% is a reasonable starting point. Also, consider the payout ratio. If a company is paying out most or all of its earnings as dividends, it might struggle to maintain those payments in tough times. A payout ratio below 70% is generally considered sustainable, though this varies by industry. Finally, think about diversification. Don't put all your money into one sector, like utilities or real estate, even if they offer attractive yields. Spread your investments across several industries to reduce risk. Here's a simple example. Suppose you choose the following. Johnson & Johnson, which typically pays in March, June, September, and December. Procter & Gamble, which pays in February, May, August, and November. Coca-Cola, which pays in January, April, July, and October, By combining these three, you'd receive dividend payments every month of the year. If you prefer funds, you might add a monthly dividend ETF, such as the Invesco S&P 500 High Dividend Low Volatility ETF, ticker SPHD, which pays monthly and holds a basket of stable, high-yield stocks. Step 4. Building and balancing your portfolio. Now, decide how much to allocate to each stock or fund. You could split your investment evenly or weigh more heavily towards sectors you believe will perform well. The key is to ensure that your portfolio will generate payments in every month. Let's say you invest $4,000 total, $1,000 in Johnson & Johnson, $1,000 in Procter & Gamble, $1,000 in Coca-Cola, $1,000 in SPHD, the monthly dividend ETF. This setup ensures that regardless of the month, you're receiving at least one dividend payment. Over time, as you add more money and reinvest your dividends, your monthly income will grow. Step 5. Reinvesting dividends for growth. If you don't need the cash right away, consider reinvesting your dividends. Many brokerages offer automatic dividend reinvestment plans, or DRIPs. With a DRIP, your dividends are used to buy more shares, which means your future dividend payments will be a bit larger each time. This compounding effect can significantly boost your income over the long run. Step 6. Monitoring and adjusting your portfolio. Your work doesn't stop after buying your initial investments. Review your portfolio at least once or twice a year. Make sure the companies you own are still paying stable dividends and that their financial health remains strong. If a company cuts its dividend or faces serious trouble, consider replacing it. You may also want to rebalance your holdings if one sector becomes too large a part of your portfolio. Other tips and considerations: keep in mind that taxes can impact your dividend income. Depending on your country and account type, dividends may be taxed at different rates. Research your local tax rules or speak with a tax professional if needed. Also, remember that all investments carry some risk. Even the most reliable dividend stocks can decline in value. That's why diversification and regular monitoring are so important. Let's quickly recap how to build your own monthly dividend portfolio. 1. Set a clear monthly income goal. 2. Learn the dividend payment calendar and combine stocks or funds to cover each month. 3. Select high-quality dividend payers with sustainable yields and payout ratios. 4. Diversify across sectors and consider monthly dividend ETFs for stability. 5. Reinvest dividends to accelerate your growth if you don't need the cash. 6. Monitor and adjust your portfolio as needed. With patience and consistency, you can create a personalized stream of dividend income that pays you every month, helping you reach your financial goals, one dividend at a time. If you found this video helpful, please consider liking, subscribing, and sharing your questions or experiences in the comments below. I'd love to hear about your dividend journey. Thank you for watching, and remember to invest wisely.